Hope you had a wonderful Thanksgiving. I know I did. We were in Eastern Oregon at my in-laws' place, and I think we were about 35 people there. 35 of us, most of them children. We have a large family. It was a lot of fun to be together. The food was fantastic as usual, and my mother-in-law is a fantastic cook, wonderful turkey, as well as my wife and sisters-in-law was great. But the number one thing that I had to talk about, the question I was asked while I was there was, hey, when are rates going to come down? When's the Fed going to cut rates? So I thought I would just let's just talk about that turkey right now. Let's discuss this question. And many of you may have had the same question if you're in real estate, talking to family and friends. And even if you're not in real estate, you may have had this same question. Okay, what's going to happen? When's the Fed going to drop rates? Well, believe it or not, like everything else, there is actually a futures contract out there for federal funds cuts, right? What do you think the Federal Reserve is going to do? So there's a futures contract on the Chicago Mercantile Exchange that's traded that puts odds on when people think the Fed is going to start cutting rates. Now, historically, over the past number of decades, it's about 10 months after the last Fed rate hike, that the first cut occurs. So the last rate hike was last July, was about 4 or 5 months ago in July. So if history holds true, we could see the first Fed cut next May. And that seems to be exactly what the odds makers are predicting here. If you see here, starting on the May 1st meeting, the next Federal Reserve meeting, there's 69%. At that point, you get over 50% of the people thinking that that's when the Fed's going to probably drop the rate the first time. And then it increases from there. And you've seen other headlines, I'm sure, the last few weeks that say, hey, we could have as many as 4 rate hikes over the past, or sorry, rate cuts over the next year, mostly in the second half of 2024. So it seems likely that that could all start to occur. But let's talk a little bit more. If that happens, that'd be great to have a Fed rate cut. But let's talk about something else that could cause rates to come down even further and have more of an effect than just a rate cut. Okay, and that would be this. I'm going to show you this chart. This is from the Federal Reserve. Get myself out of the way. This shows the Federal Reserve's assets. Well, in other words, how much debt they're carrying, right? How many bonds and mortgage-backed securities and treasury bills and notes they have purchased that are sitting on their balance sheet. How much does the Federal Reserve own of U.S. and mortgage debt, right? So about 20 years ago, we owned about 750 billion, 800 billion, less than $1 trillion. Then we had, of course, the crisis in 2007, 2008. This is TARP, where the Federal Reserve bailed out a bunch of big banks, right? And came in and purchased a whole bunch. And then they started purchasing quantitative easing, right? And they continued that. Instead of letting this run off their balance sheet from previous purchases, they did quantitative easing, meaning they were a buyer of bonds, including mortgage-backed securities and other treasury bills and bonds and notes. And they continued that and continued that and continued that until they finally, in about 2018, started allowing what's called runoff or quantitative tightening, where they weren't reinvesting the proceeds from the notes and bonds and bills that were maturing every month. So every month they have a certain amount of these debts that mature, and they got to figure out what to do with the money. They can either repurchase other debt with that, or they can allow that to run off and not be repurchased and just enter the marketplace. So they did that for a little while, for about a year. And then what happened? Well, then we had COVID, and COVID caused the Federal Reserve to step into high gear to keep the economy stable, since everything was getting shut down. They did their part to keep things as stable as they could, which was flood the system with money, purchase as many mortgage-backed securities and other bills and bonds and notes as possible. And that caused their balance sheet to really shoot up. And I mean, it already had more than doubled, right, since 2008. And now it really shot up again and doubled yet again. Okay, and they've continued that quantitative easing all the way until last spring, till spring of 2022. Then they started quantitative tightening, called QT. What that means is they're not repurchasing these maturing notes, bills, and bonds, these maturing debts. They're allowing the money to go back into the marketplace and drop their balance sheet until the banking crisis last spring, when they bailed out Silicon Valley Bank, First Republic Bank, and Signature Bank. That's what this blip is. By the way, that little blip right there, that represents over $400 billion, just that little blip on the chart. So kind of amazing. But at any rate, they've continued to allow this quantitative tightening to happen, to run off their balance sheet and decrease how much debt they're holding. If this continues over the next 6 months or 9 months, we could see them down to roughly in the $7 trillion range as far as how much they're holding of debt. Okay, that's what quantitative tightening is. Now, So if we want a larger effect than just rate cuts, let's say they start cutting the rate a 0.25% at a time or 0.5% at a time, on the federal funds rate, that's not going to reflect the same amount on mortgage-backed securities, on mortgages, on 30-year mortgage rates. Let's say the Fed comes in and cuts a 0.25% on their federal funds short-term overnight lending rate. You're not going to see a 0.25% drop necessarily in 30-year fixed mortgages. You may see a 0.25% or more drop leading up to that as the market anticipates and expects the Fed to do this. But when they actually make the drop, you probably won't see much of a change. In fact, sometimes rates go the other direction on the long end of the curve. But if the Fed really wanted to affect long-term interest rates, what they would do is begin repurchasing, reinvesting the runoff money from these maturing securities that they hold. Okay, that would really have a large effect on interest rates, or a much larger effect. So we'll see what they do. I guess in the last minutes, they have like 19 voting members of the Fed, and 2 or 3 of them are saying, hey, let's just cut rates without ending quantitative tightening. If that becomes a majority consensus, then we won't have as much of an effect on long-term rates. It'll affect long-term rates, but not nearly as much as if they would start reinvesting the money instead of allowing the balance sheet to decrease. Now, I am a very, very debt averse person. So I would prefer personally to see them kind of get out of debt, right? That would be ideal. That would mean our government is actually managing itself well, and living within its means, and not relying on the Federal Reserve to be one of the buyers. But I don't have high hopes for that. I'm afraid that quantitative easing will probably start again at the same time that they start cutting interest rates, because they'll want to have more of an effect. That would especially hold true if the economy really is faltering and we're in more of a serious recession, so they can stabilize things. And so don't be surprised if they start reinvesting again and the balance sheet is not dropping like it is now. But that is just a little lesson there to show you kind of how this works, right? Federal rate cuts, as opposed to quantitative tightening, quantitative easing, how they could work together to really have a more outsized difference. So let's take a look at where we're at right now with rates and charts. As you can see, we're up 32 basis points on the mortgage-backed security, and the 10-year Treasury is down 8 basis points. So the yield is down and the price is up, right? Price up is good for rates, yield down, good for rates. These are just opposite charts. This chart here shows universal mortgage-backed securities. You can see the pricing has improved over the past couple of months since mid-October. So 6 weeks of improvement. Nice update today, kind of making up for a little bit of down pressure last week around Thanksgiving time. We're back to the levels we saw back in September, August timeframe. As you can see, we're in that same range again. So interest rates have improved fairly significantly, actually, since the middle of October. And we could continue to see some improvement depending on what happens with some news items. This Thursday is the PCE. That's the Federal Reserve's favorite measure of inflation. That's the price. The PCE is their favorite inflation measure, I'm trying to say. So when that comes out, we'll see what happens with the core inflation measures. And if those continue to weaken and come down, and inflation continues to come down year over year, that will have a positive effect on interest rates. And then next week, we'll have the jobs data. And if we have unemployment in the 4% range, which is possible, that could really start to affect interest rates and help them along, help drop interest rates, as market participants and economists would start to expect that the Federal Reserve will shortly, sooner than later, maybe next spring, like we saw on the chart there, start to cut the federal funds rate. So hope that helps you for today, gives you some insight into what's going on in the marketplace and some forward look as to what we might be able to expect, right, from the Federal Reserve going forward.